I call this the saga of the intercompany inventory. On January 1st, 2022, Special sells the intercompany inventory for $15,000. And then November 1st, 2022, Peerless buys more inventory for $32,000. And guess what they're going to do? They're going to sell this inventory to Special for $40,000. And then Special, December 1st, Special is going to sell some of the inventory to a third party for $19,000 and still have inventory on hand of $28,000. Special Foods net income would be $75,000 and Special Foods dividend would be $40,000. So we got a handful here. So first of all, Special Foods sells the goods. The journal entry would be to debit cash for $15,000 and credit sales for $15,000. And then Special has cost of goods sold equal to whatever they originally paid, which they believe to be $10,000, and credits the inventory for $10,000. Peerless, meanwhile, goes ahead and buys more inventory. So we debit inventory for $32,000 and credits cash for $32,000. And Peerless, it's our worst nightmare, Peerless sells it to Special. So Special buys the inventory for $40,000, debits cash, Peerless debits cash for $40,000, credits sales for $40,000, and debits cost of goods sold for the original cost, which was $32,000, and credits inventory for $32,000. Special Foods is going to debit inventory for whatever they paid, in this case $40,000, and credit cash. Don't know what I just did. Credit cash for $40,000. And then Special goes ahead and debits cash, makes a sale for $19,000. But I got this date wrong. This is December 1st. And this is November 15th, 2022. And I see here a few more incorrect dates. I'll fix them. There we go. Now we could do that convoluted little table that the book is so excited. So we have here, you can just do this on scrap paper, minus cost of goods sold equals gross profit. And you have the total, you have resold, and still here. So the total amount of the sale, in this case, was $40,000. The cost of goods sold was $32,000, and the gross profit that's built in is $8,000, and that is a gross profit ratio, quite conveniently, of 20%. So how much was resold? We don't know. All we know is that, according to the problem, $12,000 is still here, because we don't know what this sale cost. But we do know that $12,000 is still here. It doesn't say it here in the problem, but it's in the book, trust me. So $12,000 is still here. Therefore, you must have resold $40,000. You must have resold $28,000, the difference between them, because you started with $40,000, you have $12,000 still here. You must have resold $28,000. So your gross profit would be 20% of this. And this is actually wrong. What's still here, it says 28,000 is still here. So 12,000 was resold. That makes more sense because they sold it for $19,000. So then the cost of goods sold for this must have been 80% of 12,000. Right? If the gross profit was 20%, then the cost of goods sold was 80%. And the amount of gross profit that needs to be deferred is going to be $5,600. Sorry about that mistake. This number here is given to you in the textbook. You would need to know it, obviously. So if you're wondering, on Special Foods books, the cost of goods sold of these goods is $12,000. So what they're going to do, Special Foods, when they record the sale, they'll debit cost of goods sold for $12,000 and credit inventory for $12,000. And what's most important is the unrealized gross profit. This is the number that keeps you up at night here. That's what we got to take care of. Back to Peerless. So Peerless now is going to record its share of the income because that's the next thing that happened. Oh, here you go. Special still has inventory on hand of $28,000. So from that, we know that still on hand is $28,000. The parent recorded $22,400 in cost of goods sold, so you still have $5,600 in gross profit that you got to worry about. Okay, Peerless had Special had net income of $75,000, of which 80% belongs to Peerless. So that would be $60,000. Debit investment in Special Foods. You have to know that I've been debiting investment in Special Foods for about 12 years. Let's see here. Where is it? There you go. Net income times 80% is going to be $60,000. Credit income from Special Foods. See, you think, why can't you do a different example? It's nice because it's very clear. And that's why I like that the book has a single example that they use throughout the text. At the same time, it gets a little tedious, right? So then we have the dividend. The dividend is, of course, in the second year, it's always $40,000. There it is, times 80%. That's not 80%, I wrote 89. There we go. And credit investment in Special Foods stock, $32,000. Now, here's where things get interesting. Previously, we deferred $3,000 on the books of Peerless for the inventory for the deferred gross profit because the inventory hadn't yet been sold to the outside. But at the beginning of 2022, it was sold to the outside. So now the parent can take this into income. So the parent is going to debit investment in Special Foods for this amount, $3,000, and credit income from Special Foods for $3,000 because now the parent can recognize that gross profit. And the other piece of this now is that the parent now needs to defer the other $5,600 that needs to be deferred because the sub has $28,000 inventory sitting on their books. It really only costs $22,400, so $5,600 needs to be deferred. So on Peerless's books, Peerless is gonna debit income from Special Foods for $5,600 using this handy dandy little chart, and credit investment in Special Foods for $5,600. And now we do our worksheet. The big elimination entry, again, is going to follow this new format. How your book does this is a little weird. I'm going to do it out of order, simply to make it clear what they're doing. A lot of times what happens, I like what they do because it's like the real world. A lot of times people do journal entries and you have to figure out what they did, and that's kind of what we need to do here. Anyway, I'm going to do the journal entries a little out of order so you can see some of the footwork we need to do in order to get this to work. the first thing that I'm going to do is I'm going to eliminate that $3,000 from last year, and I'm going to take it into income now. That $3,000 is going to go in, is going to be credited to cost of goods sold, because the sub is going to record $10,000 in cost of goods sold and really should only be recording $7,000. And the debit is actually going to go to the investment account, because that would be where it's sitting resident right now. And in a moment, you'll see why I had to do it this way. So there you go. I'm going to do that first. And then I'm going to do my big elimination. And again, I'm going to use the format that the book uses, which is problematic. But I'm going to debit the full income from special foods, debit the non-controlling interest share of net income of special, 20% of $75,000 or $15,000. I'm going to debit beginning retained earnings, credit the dividend of $40,000, and I'm going to credit investment in special foods for the difference between 278 and 3,000, really the total of them, whatever I need to do to get this down to zero. It's kind of a, and you can see there that that worked. It's a little weird that I'm doing that way, and what's even more strange, I'm going to debit common stock. What's even more strange is how I calculate the non-controlling interest, kind of as a plug. And what the book does is it gives you a roll forward method, although honestly, I think they could give you a lot more detail on how they got these numbers. So, you know me, I'm always telling the textbook authors what to do. It's $71,000 here. If you think this is confusing, it's because it's confusing. But I'd like to see the method that they're using. And again, I would do this investment in special food stock entry first, to reverse it in order to get at what you need to get at here. And what might happen is you do this one first and then it doesn't balance. Anyway, not thrilled with how they do this. Let's do our accumulated depreciation entry. And then the other thing that I need to do here is I need to reverse the new intercompany sale that I made, because I made a new $40,000 sale. So I'm going to debit sales for $40,000. I'm going to credit cost of goods sold. Rather, I'm sorry, I'm going to credit inventory for the deferred gross profit, in this case, $5,600. And the difference between these is going to go to cost of goods sold right here. And this is how this would work if you had a partial sale of these goods. So this is, honestly, it's kind of convoluted how the book went about doing it, but I wish they were consistent from one chapter to the next, and it's something that each edition of the book I hope they fix. But it's good for you, because in the real world, sometimes things are convoluted, and you need to know how to deal with that. So here you can see the income statement, and everything's all added up. Again, we want to make sure that net income to parent is the same as consolidated net income. Retained earnings of Peerless is the same as retained earnings consolidated. The balance sheet balances, debits equal credits. That I tested it. Yeah, I'll do it for you. And make sure that everything balances. The investment account is down to zero. And again, there is a way of rolling this forward. The book is very unclear about it, and I've gone over a few different ways that I think would work to do it. But honestly, for practical sake, the easiest thing to do is just do this, is record the gain first, and then plug the number to 0, and then plug in your non-controlling interest, just for convenience sake.